Yeah, there's some gold out there. There's more gold to be found. I'm not saying the industry is going to zero, but they're having a tough time expanding output. The main thing to do is a couple of things. They're almost constants, not quite, because it's not a set and forget it type portfolio. But you definitely want 10% gold, and whether it's physical bullion or some kind of fund. I recommend physical bullion, but if you have an ETF or something, at least you get price exposure. Gold mining shares, and you can look at silver miners and all that. But I also recommend a big slug of cash, maybe 30% cash. I recommend lightening up on equities. I think equities have a lot further to fall. There's been a spectacular rally from March 23rd to September 2nd. We had the shortest bear market and the fastest return to a bull market in history. But it doesn't mean this is over. That was sort of, I call the S&P 500, I call it the S&P 6, because it's really only 6 companies that are dragging along the other 494, because it's a cap-weighted index. So when you look at Amazon, Apple, Microsoft, Netflix, Facebook, and Google, or Alphabet, those 6 stocks are almost 40% of the weight of the index. So if they go up, the index goes up. A lot of people don't pick stocks anymore. They just buy index funds. So their index funds go up. So it's all sort of going up together. It's all good. But there are 2 problems with that. Number one, how sustainable is that? And by the way, the 6 companies I mentioned, they're the least affected by the pandemic. The idea that money printing causes inflation is just not true. Now, everyone believes it's true. The monetarists, the Milton Friedman followers, the Austrian economists, even the neo-Keynesians say, yeah, if you print a lot of money, you get inflation. It's not true. And just for empirical evidence, I don't just say things like this without backing them up. Between 2008 and 2015, when they ended, 2014, when they ended QE3 at the time, the Fed expanded its balance sheet by almost $3 trillion. And we never had inflation. We never had serious inflation. You get 1.5%, but we never had serious inflation. The whole time the Fed had a target. This is 11 years if you want to go all the way to the end of the expansion in 2019. Technically February 2020, 11 years, and the Fed never hit their target of 2%. A couple months, yeah, but not on a sustained basis, and certainly nothing above that. So I like to say it's a sad day when the Fed wants inflation and can't get it, and they do want it. The greatest danger in the macroeconomy today is deflation, because of declining labor force participation, declining productivity, and most of all, velocity. Velocity is the turnover of money. It doesn't matter what the money supply is. If it's not turning over, if there's not lending and spending, if people aren't chasing the goods, then you're not going to get the inflation. And so, but velocity, as I just described it, is a psychological phenomenon. How do you feel? Do you feel prosperous? Do you feel confident? Do you want to go out and buy dinners on me or drinks on me or whatever, buy a new car set? Or do you feel cautious? Do you feel concerned? You saw your neighbor lose her job. You're worried about losing your job, etc. So you save more. Well, the evidence is people are saving more. We're in a liquidity trap. Saving was sort of kind of working its way up from 5% to 8%. In April, it was 33%. In May, it was still 25%. In June, it was 17%. So savings can be a good thing, but in the long run, if you have productive investments, and that's a big question, but in the short run, the savings come out of consumption. If I make money, I'm either going to save it or spend it. Well, if I save more, I'm spending less. So all the signs are point to deflation. The Fed can say they want inflation, and they can print all the money they want. It doesn't mean they're going to get it. If you lost your job, you're going to, hey, I got to pay the rent, I got to pay the mortgage or the kids' tuition or healthcare. So I'm going to save more. I'm going to cut out, dinners and vacations and club memberships and discretionary items. If you didn't lose your job, but your neighbor did, you might be worried, how do I know I'm not next? Look at the companies that went bankrupt. Pier 1, Neiman Marcus, JCPenney, Brooks Brothers, Gold's Gym. I mean, the list goes on and on. My new book, The New Great Depression, is going to take the story forward and tell you what's going to happen in the next couple of years. But the deflation story is not new, Danielle. It's been persistent, and it's getting worse. The Fed does. I could tell you how to cause inflation in 15 minutes, but unfortunately, the Fed kind of forgot how to do it. I like to say there are 2 kinds of buyers of gold or investors in gold. Generally the strong hands, pardon me, the strong hands and the weak hands. The strong hands don't use a lot of leverage. They, use cash or capital. They're in it for the long haul. They're not day traders. I watch the tape because I'm an analyst and I do a lot of interviews about it and I write about it. But I'm not a day trader. I don't get too euphoric if gold goes up. I don't get depressed if it goes down. I know where it's going in the long run. It's going to the kind of neighborhood of $15,000 an ounce. As far as the stock market is concerned, and this happened, you're right, it did happen in 2008. I remember the worst part of it in 2008 in September, October, November, when the stock market was absolutely crashing. Gold was going down, and I was getting all these calls. Hey, Jim, gold's safe haven. How come it's going down? But what happens is, in a liquidity crisis, everybody sells everything, especially the weekends. If you're leveraged and you're in the gold futures market, and you're long and the market's collapsing, you got to sell. You got to get out. You got to cut your losses. But also, if you're losing money in stocks and you're losing money in mortgages, which was the case in 2008, today, as we saw since September 2nd, the market's down substantially. People get margin calls. If you're a leveraged player, you got to either come up with cash for the margin or you have to sell your position, which makes it worse. So what people do is they sell gold to get cash to meet the margin call on the stock losses, or they're on the wrong side of the gold market and they're leveraged and they just sell to cut their losses. So it does go down. It's highly predictable, but strong hands are waiting. It's like if you've ever seen a lynx or a mountain lion hunt, they don't stalk their prey, they just wait. They sit there and wait and then they pounce. Strong hands are watching, they don't jump in on day one, they wait till it goes down enough and then they come in and buy and it goes right back up. I would put Buffett in the category of strong hands, but Buffett wasn't around, he was around, but he wasn't buying gold in 2008, he wasn't buying it in 2015 when the stock market went down sharply. But if you, again, look at every one of these instances, Danielle, you'll see that the immediate reaction to gold was down, then it finds its footing, and then it goes straight back up again. I fully expect that to happen again. An interesting thing about the United States, the U.S. gold supply went from about 20,000 tons in 1950 to 9,000 tons in 1970. Then there was a run on the gold bank. It dropped even further. That's when Nixon shut the gold window in 1981. But the U.S. still dumped gold alongside the IMF between 1971 and 1980. But 1980, we just stopped cold. The U.S. gold supply today is almost exactly what it was in 1980. But what we, the United States, did is we got everyone else to do our dirty work. So what does that mean? The UK sold over half their gold in the late 90s. The Swiss National Bank sold 1,000 tons in the early 2000s. Canada sold all their gold. You and I have more gold than Canada because Canada has zero. If you have one coin, you have more gold than Canada, et cetera. And the IMF sold 400 tons in 2010. So the U.S. didn't sell any more gold after 1980, but we were getting everyone else, again, Canada, Switzerland, UK, IMF, and others to sell their gold. Finally, they said stop also. There was almost a referendum to stop this happening legally in Switzerland and so forth. So everyone else stopped selling gold. So now you have one group of central banks who are buyers, another group of central banks who are just sitting tight. So that increases demand. Supply is flattish. Supply is going down, demand's going up. I don't have to tell you what that does to price.